Hey fellow investors, the volatility in the market is really no joke. Every night at 9:30 p.m. when the US market opens, I'll be glued to my screen and watching the action, ignoring my wife and kids. Just yesterday, I thought we saw some signs of relief. Most Asian markets, except for Singapore, unfortunately, bounced back, with European shares rallying a whopping 4% to 6%. The US market opened with optimism, but by the end of the day, the 4% rally fizzled out into a 2% decline. In just the past few days, we've seen extreme ups and downs, enough to make even seasoned investors feel a bit giddy. So in this kind of environment, where the markets are unpredictable and investor sentiment is fragile, I thought I'll quickly share with you today the 3 shares and REITs I personally have no worries holding, even if things remain bumpy like today. These are steady, reliable, no-stress picks, the kind of companies I can hold and just collect steady dividends without checking on their performance. And at the end, I've got one special bonus pick. It's what I call a cigarette butt investment. Small, a bit battered, but with one last puff of value. I'll explain what I mean later. But before we dive in, let me remind you that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the shares discussed, but what works for me might not work for you. Alright, let's get started. Netlink NBN Trust, ultra stable, boring, and that's why I love it. The first on my list is one I always go back to when markets get stormy. Netlink NBN Trust. Now, when people ask me what's the most boring stock in Singapore, I happily say, this one. But boring is beautiful, especially in times like these. Netlink owns and operates the nationwide fiber network infrastructure in Singapore. That means whether you're watching YouTube at home, doing Zoom calls for work, or even listening to how the stock market is doing, there's a very good chance you're using their network. And because it's part of the country's essential digital infrastructure, its revenue stream is remarkably stable. Some analysts even call Netlink's returns bond-like, and I get what they mean. The dividend payouts are very stable, and the business model is incredibly predictable. But let's be clear, this is still a share, not a bond. It carries equity risk, and its price can fluctuate with the broader market. That said, it's one of the few listed entities I can genuinely say I don't lose zero sleep over. The dividend yield is more than 6%, which for something this stable, is more than enough for me. I don't expect huge capital gains here, but for peace of mind and steady income, Netlink is hard to beat. Over the past 5 days, which have been the most volatile over a long time, Netlink has dropped by only 2.3%. This is the kind of share I hold and forget about. Until I need it, then I smile at the dividends quietly rolling in. Parkway Life REIT, defensive healthcare income, year after year. Next up, Parkway Life REIT, the healthcare REIT that just refuses to disappoint, and one I regret not getting in much earlier. This is a REIT that owns hospitals in Singapore and a portfolio of nursing homes in Japan. It's one of the most defensive S-REITs out there. Why? Because healthcare demand is largely recession-proof. Whether markets are up or down, people still fall sick, and hospitals still run. The rental structure for Parkway Life Singapore hospitals is incredibly stable, with built-in rent escalation based on CPI plus a floor. That's a fancy way of saying, income goes up slowly but surely. During COVID, while other REITs were slashing distributions, Parkway Life's DPU quietly climbed. And now, even with rising interest rates, the REIT's strong balance sheet and low gearing give it the firepower to handle volatility. In short, it's the kind of REIT I can hold through almost any cycle, and sleep well at night. Over the past 5 days, it has remained almost flat at a 0.25% decline. Its dividend yield at 3.7% is lower than other REITs, but Parkway usually makes up for it with more stable prices, which is important in such volatile times. Before we move on to the last one, if you found this video helpful so far, do help this uncle out by tapping the like button. It really helps the channel grow, and tells me to keep making these videos for you. Alright, let's jump back in. A surprisingly resilient pantry pick, QAF. Now here's one that may surprise you. QAF Limited. If the name doesn't ring a bell, maybe this will. They're the folks behind Gardenia Bread. Yes, the one you see on every supermarket shelf, and probably in your own kitchen too. QAF is a diversified food company involved in bakery and distribution. But the star of the show, at least for us in Singapore, is Gardenia, and in tough times, people tend to eat more at home. If there's an economic downturn, I don't think people will rush to Toastbox every morning. They're more likely to spread kaya on gardenia and have breakfast at home. This gives QAF a kind of quiet resilience. People still need to eat, and bread is affordable, convenient comfort food. And here's the kicker. QAF has consistently paid out around 5 cents in dividends over the past few years, translating into a dividend yield of nearly 6% at today's prices. That's not bad at all for a consumer staple business. Over the past 5 days, the share price declined by less than 3%. Now, it's not the most glamorous company, and it doesn't make the news much, but that's exactly why I like it. It's under the radar, profitable, and pays me decent, regular dividends. Just like how gardenia bread is soft and reliable, QAF gives me the investing equivalent of a warm, stress-free breakfast. Paragon REIT, the rare cigarette butt investment that might actually work. And finally, a bonus sharing on something a little different. Let's talk about Paragon REIT, which is currently in the process of being privatized at 98 cents per unit. Right now, it's trading at around $0.965 to 97 cents. So if the privatization goes through, which looks quite likely, there's a potential gain of around 1% in less than 2 months, with completion expected by end May. Now, this is what I call a classic cigarette butt investment. The term comes from Warren Buffett, who described it as picking up a discarded cigarette butt off the street. It may only have one puff left, but that puff is essentially free. In investing terms, it means buying into a company or REIT that may not have a bright future, but still has a small, nearly certain return left in it. That's how I see Paragon REIT right now. I'm not buying it for long-term growth. I'm buying it for that last puff, the 1% return if the deal goes through. It's not a life-changing amount, but in today's volatile markets, a short-term, almost assured gain like this is rare and worth considering. Of course, nothing is 100% guaranteed. But the privatization vote happens on 22nd of April, and with strong backing from the sponsor, the odds look good. But if a last tiny puff is not what you're looking for, remember the 3 shares and REIT we discussed earlier. The dividend uncle's take. Calm, collected. When markets get this volatile, some people freeze, some panic, and others try to guess the next big move. But for me, I try to stay calm, keep collecting my dividends, and look for low-stress opportunities. That's what today's video is all about, focusing on shares and REITs that don't keep me up at night. Whether the market goes sideways, drops another 5%, or rebounds sharply, I'm comfortable holding these. They provide income, resilience, and in some cases, even upside. And of course, if there's a little bonus pick that gives me a quick, near-certain gain while the rest of the market is full of drama, I won't say no to that either. That's what the Paragon REIT opportunity is to me, a small reward for paying attention when others are distracted. That's all for today. Let me know in the comments what your no-stress shares are, or if there's one you're thinking of adding during the volatility. And if this video gave you some peace of mind in this shaky market, you know what to do. Give this uncle a like so the YouTube algorithm also relaxes a bit. Until next time, stay steady, stay sane, and invest wisely.